Sometimes when we think about risk tolerance, we overthink it, right? And we like want to try to be real exacting and all that. We either do that or we're kind of have that gut feeling like, I have a feel for how much risk I want to take in terms of how much I might want to own in stocks or crypto compared to less risky or technically volatile investments like bonds or cash. I found this, simple kind of tool you can use, the kind of infographic. I'll walk you right through it. So let me show you that. And then you can see, maybe a way that you can take a look at it too as well. All right, I'll have the link in the description here. It's from Ameriprise. They're a financial services firm, financial advisor, and they had a little article here on risk. But one thing I liked was this assessing your risk tolerance, a very simple type thing. Let's walk through that. And so you can kind of get a feel for your risk tolerance. And it's really, determining, high risk and your investment mindset and the variability of returns all the way down to low risk here, right? So you get the idea there. So, and it's basically just thinking of your mindset and asking questions is a good place to start. So if you think of your mindset, I don't mind losing money. I don't mind if I lose money. You might be more of an aggressive investor, and this will give you the highest potential fluctuation of all or most of your account value could be lost, right? That might be something super aggressive, like putting into certain alternate coins in crypto or something like that. And then down to I can tolerate some loss, so moderately aggressive, so relatively high fluctuation, and so on. So a lot of moderate investors are right in here. I'm okay to have a little loss. I know investing means there's some gains, but sometimes I have losses at time, and that there's going to be a fluctuation in account value. So a lot of people fall into moderate. Or maybe moderately aggressive. I would probably be more at the top of moderately aggressive, possibly. Especially as I'm older now and I'm financially independent, I was certainly more aggressive when I was younger. I had a longer time horizon. So, but I'm still, even for right now, would be considered really in the moderately aggressive area. There's a kind of funny thing. I should probably be moderately a moderate, or a lot of folks now would be, if they're financially independent, more moderately conservative. But I'm hoping to have a long life expectancy here, so we want my investments to keep growing. So if you have like a hard time tolerating losses, well, that's moderately conservative. And so you'll have low fluctuation, you'll be more conservative investments, more bonds, cash. And if you're real conservative, so I just need something safe and I need to get a little return. I don't even want there to be a lot of money, growing necessarily. I just don't want any kind of fluctuation at all. Then you'd be conservative, so you'd be more in the low risk. And that's okay. That's actually a point where you're retired, maybe you're financially set, maybe you're older, maybe you're in your 80s or 90s. You don't need to have a lot of growth. You just need to not lose money, so to speak. So you're more towards that end. So this is a nice thing. Again, I'll have the link in the description. I also have like free courses and all sorts of other good stuff in the description. So do click down there and take a look. And you can kind of just get a feel for where you might fit on that. The other thing that was nice in this article too, if you scroll down, then they break out these risk tolerance category grades a little bit more, from conservative, to aggressive to moderately aggressive, so it's just a little short bullet point thing here. So if I was moderately aggressive, it says I am seeking a relatively high return potential, willing to accept a relatively high fluctuation, potentially substantial loss in my account value. Certainly over certain periods of time. I don't want my whole account value to go down or be terrible. Nobody wants that. But I'm willing to accept more losses. So when we have, like, let's say, especially in early 2022, when we had a bear market and stocks went down 20% or a little bit more than 20%, being more heavily invested in stocks, I took more of a hit than somebody who was, let's say, more in the very moderate or moderately conservative type area. But again, over time, I will have outsized returns versus them as well. It's just a matter of how you're able to handle that risk aspect. And really, risk aspect is, there's a lot of different things to risk, but one thing with risk is, well, what's the risk I'm going to lose everything? Which is actually kind of rare. I mean, certainly you could buy a stock, company goes out of business, those kind of things, or crypto goes to zero. Those things happen. But in general, especially for more established stocks or more established things, it's not going to go to zero, but you might lose a lot of money. You might lose 50%. You might lose 70%. You can lose money for sure. But really, when we talk about risk, in most cases, we're talking about volatility, as in prices going up or down, right? Even the broad market has volatility going up and down. Though we do know the broad markets, like the S&P 500 stock market, for example, 500 largest USA companies, if you look at their chart over time, it goes kind of on this pattern, right, where its prices are rising over time with these basket of index type stocks. Now, as it goes up, there's fluctuations, and sometimes we have deep dives in those situations, like 2008, 2009, the Great Recession, we had a big drop. Certainly early days of the COVID-19 pandemic. Remember how, if you were around then investing, how fast that dropped down? And now in 2022, we have inflation and global crisis, all sorts of stuff going on that's caused a bear market too, so it's gone down there too. But in each of those cases, they've rebounded back up. And we'll see about certainly as far as the bear market. But bear markets tend to last about 9.5 months, by the way. I have some videos on that too. So it lasts about 9.5 months. So the whole idea of all this is you want to get on the scale or in the area that fits you best in terms of your risk and tolerance. And if you can get a little bit more risk in there, you're going to get a little bit better return too. So if you have to kind of decide one way, try to take on a little bit more risk, unless you're really, really uncomfortable, then it's okay. The real key is that you're investing. The best thing you can do is invest. Even if you're more conservative, moderately conservative on the scale, that's okay. You're investing. That money's still working for you. And the more risk you can take on, the more it'll work faster for you, is the idea of compounding and growing over time. All right, so there's a quick little thing you can look at. Link will be below. If you like this kind of stuff, hey, don't forget to hit the subscribe button, and hope to see you in another video.